Martin Turner here. This week we turn to management accounting as we look at understanding key cost relationships. We first look at how we use cost objects. We then look at period and product costs and the importance of this key distinction in the costs of our firms. We then look at direct and indirect costs and how these are allocated to products. Looking at understanding key cost relationships, and in our workshops we'll be looking at assignment 2. The first thing we'll look at today is cost objects, and this is a key idea in management accounting where we attach costs to various cost objects. Then we'll be looking at period and product costs. This is a key distinction in accounting that you need to be very clear on, and we'll be spending time with that. Then we'll look at direct and indirect costs, costs that we can easily attach to cost objects, so direct costs, costs that are not so easy to attach to cost objects, or indirect costs. And we'll be looking at some techniques around that, job costing and process costing, functional-based costing systems and activity-based costing systems. This is only very much an introduction to these ideas. Then we'll have a minute paper. Well, here's the first question. If you could answer this one on the next slide. Why is so much effort put in by managers into managing costs? Why is it all so complex? A number of people have been discussing this in their assignment 2, step 2. It's been a bit of a surprise to them that managing costs in a business is not quite as straightforward as they thought. So why is that? Why is so much effort put in by managers into managing costs? And why is it all so complex? Got a microphone open. Nodding for your microphone to open. Close your microphone, please. And we've got 2 responses so far. 3. Give you 30 seconds. We've got over 50 participants in class so far today, so you can write whatever you like. Ten more seconds, you can write something in. We've got 10 submissions, 10 out of 50. We can have everybody write something. Maria, can you read that all right?
I think so. I'm almost at the point where I might end the video conference and try and log in with Zoom, but at the moment I can read them. Do you want me to start going through them?
If you can see them all right, it's probably easier to be in Zoom, isn't it?
Yeah, I think I might, between this one and the next interactive slide, I might do that. Okay, so managers put so much effort into managing costs to figure out where costs are coming from, why they are incurring, and making decisions as a result of finding these costs. So that's very good. It also, that answer was indicated that there is a lot of complexity, which was part of the question. Why is it all so complex? It may affect their bonuses. That's true. That's insightful. Because lowering costs increases profit. Well, you would think so, but sometimes lowering costs doesn't actually increase profits. And I think Martin touches on that today too. To prepare for the future, there are many, I'm not sure what that word is, something costs that the company can't prepare for, or uncontrollable costs that the company can prepare for. So there can be unforeseen costs. That's true. Like COVID-19 brought a few unforeseen issues which caused unforeseen costs. So that's true. To try and best prepare for the future, I suppose. To keep costs under control, it allows managers to plan for the future, set goals, and make sure all costs are contributing to the firm's profitability. So there's a few elements in that answer, actually, incorporating a few. Actually, there's somewhat ideas from the study guide I read into that answer, so that was a nice answer. It is because everyone is spending other people's money. Oh, that's an interesting point. Well, in some cases, a firm is your own money, really, especially if you're a small mum and dad company. But when you start getting your management separated from your owners, then that issue does come into play. There's a relationship we call agency, an agency relationship, which introduces a whole host of other issues. Because that is what drives profits. There are a lot of different costs, both direct and indirect, to consider. Yes, that's true, and Martin will cover that today in the lecture. It can get out of control if managers don't. Can't see that word, Martin. They don't keep an eye on costs.
I think reading it, I think. Yeah, get out of control if managers don't keep an eye on the costs. I'll finish it off. It's all right, Marie.
All right, thank you.
You're going to. Yeah, there's a lot of effort because costs are generated by every activity that the business undertakes. We must keep track of them to ensure the business is operating in a way that generates profit. That's right. Quite a lot of people got the idea that costs can get out of control if we don't keep an eye on them. One of the reasons for that is that the staff within a business are spending other people's money. And a lot of people have commented on that. Tasman Mamal, could you close your mic, please?
Sorry, almost forgot. Sorry.
Yeah. It is because everyone's spending other people's money. There's a lot of effort because costs are generated by activity for higher profits, for managers to better understand each detail of what is going on within their firms by breaking the cost of products into groups. Managers, that's sort of like cost objects. Managers can find out which assets and liabilities are running their firms. They can identify keep costs under control and help them make decisions in relation to their business. So there's all sorts of ideas there, and it isn't. And as we go through today, you'll see it's not such a straightforward issue to keep track of costs of the business, and I quite like the answer. It may affect their bonuses. So management, particularly, might be a little bit conflicted about how they allocate costs in a business, in order to do it in such a way as to maximise their bonuses. So cost objects. Cost objects are not cost objects, not cost objectives. There's a few people who call them cost objectives. I'm never quite sure why. Cost objects, and it's any aspect of a business, any aspect. It could be a product, but it can also be a process within the business. It could be a customer. It could be an item of plant and equipment. It could be anything. Any aspect of a firm that managers want to know its costs. Second question, why are cost objects an important concept in management accounting? So we just said that this concept of where one aspect of a firm we want to know its costs. Why is that such an important concept? Oh, we've got one submission, 58 people. It seems like quite a simple idea, this idea of cost objects. Any aspect of a firm, we want to know its costs. So we have this idea of attaching costs to different cost objects in a firm. Why is that such an important concept? I'll give you 10 more seconds.
Martin, can you hear me? It's Maria.
Oh, Sagar, you've got your mic open. Sagar Dylan, if you could close your mic. Thank you. keep them coming in. We've got 4. The why is this such an important concept? This was a bit of a new concept to most people, the idea that you attach costs to different aspects of your firm. The same cost can be attached to multiple cost objects. Why is this such a powerful idea? Well, one person said cost objects because this is where managers find out why costs have occurred. If they're trying to identify where, if you've got this huge amount of costs in your business, Ryman Healthcare has costs of over $1 million a day, every day of the week, including Christmas, over $1 million. And Pankaj, if you could close your mic, please. Every day. And so how do you keep track of all that? Like hundreds and hundreds of millions of dollars worth of costs. Gajan, if you could close your mic. Pankaj, close your mic. Also, anyway, it's always good to come to class on time, but all you're doing is interrupting us by coming in now. Pankaj, if you could close off your mic. Cost objects drive profitability because they help make sense of costs, because they help attach costs to products and services. We'll see that's important. And and we'll see that attaching costs to products is important. How do we get a price? How do we decide what we're going to sell our products for if we don't know what it costs us to make them? And the same relates to services. These are the items that are generating costs or expenses in the business. If we monitor them, we can control and allocate costs correctly. Yeah, so we can keep an eye on it. So we could allocate costs to a customer, and we could see that some customers are costing us perhaps more money than we're getting from them. So maybe they're not so valuable. There could be some other customers where we make a lot of money. Prakash Prandi, if you could close your mic. One person said, not sure. Good answer too. We're going to have a look at why that's important today. As we go through understanding key cost relationships, you'll see the importance of being able to allocate costs to cost objects. And we'll be focusing on products as a cost object, which is a very common one. All our firms will want to know the cost of their products. And we'll see the importance of being able to do that. To keep onto of where money is being lost in a firm. So yes, if you've got your costs blowing out overall, you need to focus in on certain aspects of the form. So breaking it up into elements is a good idea. Cost objects can be divided into direct and indirect costs, which benefit the production process. It is important to check both costs to ensure that each cost is optimal efficiency. All right, so there's a few ideas, and I think about why cost objects is such a key concept in accounting as we go through to the next class. Thao Bach view of costs in a firm. Thao studied this subject a long time ago in first year accounting, probably 12 years ago or more, actually, 12 or 13 years ago. And when she read the chapter 6 of the study guide, she thought to herself, there's all these different costs everywhere. I'm going to do a bit of a chart to try and make sense of them. Thao was trying to understand for herself how all these cost concepts fitted together. And so she came up with this chart. So she started with all the costs of a firm. And she saw that all the costs are broken into product costs and period costs. And that's the top part of the chart up here. So we can have product costs and period costs. And that's a key distinction so here we are, product costs and period costs. So she saw all the costs of a firm could be broken into 2 items. All right, what is the difference between period costs and product costs? And give an example of each, a product and period costs from your own firm, if you can do that. What is the difference between period costs and product costs? That's the first question. Thao Bach, she saw that all costs are either period or product costs. So what's the difference? How would you tell a period cost or product cost if you met it in a dark alley? What would it look like? What are period costs and product costs? I've said it's a key distinction in costs. If you're going to understand accounting at all, you need to be very clear on this distinction. And it was in the study guide. So what is the difference? Let's have a look. No submissions. got 68 people here now. So for those who came late, you need to just connect to Echo 360. Lecture slides are from week 8 of the Moodle, and then you can start to answer some of these questions. So what is the distinction? Is that we got one in anymore? Quite a few people didn't comment on this in their step 2, period and product costs, but some did. Certainly quite a few did too, but some didn't. So what is the difference? Period costs, keep them coming in. We've got 3 now. Period costs are other costs not directly affected by the products. Not directly affected by the products. It's almost just saying the definition is that period costs are costs that we treat as expenses in a period. That's why we call them period costs. We don't attach them to products. So they're expenses of a period. Product costs we attach to products. And keep talking about that distinction in a minute. Product cost is a cost attached to a specific product. That's right. I'm not sure what they actually are, but I feel like product costs kind of relate to cost of goods sold. Now, that's a very important point. The reason the distinction between period costs and product costs is so important is that period costs are treated as an expense in the period, whereas product costs are not. They are attached to a product. So they go into inventory, which is an asset. So they go into an asset, and they only become an expense when the product is sold, and they become cost of goods sold, which is an expense. And the product might be sold in another period, and a certain amount always is. So they'll become a cost of another period. Not sure. Period costs are expenses like electricity and rates. See, you've got to get beyond just thinking of the concept with examples. The reason for that is all these examples could be period or product costs depending on the situation. So you have to go a little bit deeper than just having a few examples of what might often be a period cost or might be a period cost for your firm, but they mightn't be for another. What is a period cost? Period costs are not electricity and rates. They could be allocated to products, and they sometimes are, and often they may not. But what is a period cost? It's not a particular type of cost like that, electricity or rates. What is it? It's a cost that we expense in the period. We don't attach it to products. That can be true for electricity and rates, but we can also attach the products in some situations. Product costs are the costs of items that directly make up the cost of the product. That's exactly right. Like ingredients in food that's being manufactured. That's true. Product costs are direct costs to making a product, and they're costs that are easily allocated to a product, and that might be raw materials, for example, into ingredients that might be going into chocolate, for example, if you're making a specific type of chocolate. And we'll be looking at different ways of allocating some of these costs, but the direct costs, but it's also indirect costs. It's also the indirect costs that we attach to products. And we'll be looking at various ways that we allocate indirect costs to products. Period costs are costs not associated with one specific production process. Product costs are costs associated with one product. Well, clearly, with indirect costs, we allocate them across a number of different products. So so product costs are ones that end up getting attached to specific products, but they could be associated with a lot of products, and we just break it up throughout various processes to attach to certain products, parts of those costs. So that's not quite so true, that comment. Product costs have direct and indirect costs, that's correct, and period costs are costs that are not attached to the products. That's the definition. Period costs are those that indirectly affect the production of goods and services. Product costs are the main liabilities for production. It's also got some truth to it, but you see how vague that is. Period costs, it is true at one level, that at a sort of superficial level, they indirectly add value to the product and services. But the point is they are so indirect that we don't attempt to allocate them to the products. But we do allocate indirect costs to products. Product costs are the main liabilities for production. Well, it's not liabilities. Product costs are expenses. They're not liabilities. It is similar to the way we have to separate O from F. No, it's not. But you see how we make these various distinctions. O and F is operating and financial, which we're doing for our restatements. Period and product costs is different. Period and product costs, or period costs could be operating or financial, and product costs will typically be just operating. But that distinction is not related to the concept of the distinction between period costs and product costs. Period costs are ones that are changed over time, like electricity. Product costs are used to make a product. Well, all of our costs, in a sense, are used to make our products and services. Otherwise, why would we be incurring that cost? So it's period costs. You know, you might have the CEO's salary, which you decide you're not allocating to products, but you're paying the CEO because that person is contributing in various ways to the products and services of the business. They might be doing it through others and through managing people, but that's... Period costs are not attached to products. This is a key idea. We do not attach period costs to products. They're expensed in the period. They're expenses in the period. They are seen as expenses for the period, where product costs are seen as an asset. So that's the key idea. Sounds like I just said something I said a little while ago. Period costs accumulated if not consumed in that period. No, period costs are expensed in the period. They're just expensed. They're not accumulated. They're expensed. Product costs involved to sell the product. What's the cost involved to produce a whole lot of things? Often the selling costs are not attached to products. They can be. The key difference between product costs and period costs is that product costs are only incurred if products are acquired or produced, and period costs are associated with the passage of time. Again, that's not right. Period costs are not associated with the passage of time. The period costs, they're called period costs because they're expenses in the period in which we incur them. We don't attach them to products and end up in inventory and so forth. Alrighty. And give an example of each. Is anyone able to come up with one? A period cost for my firm is advertising. The product cost for my firm is supplies needed to create a product. Advertising will often be a period cost for most firms. They won't attempt to allocate that to products. But it is possible to do that. Advertising costs can be, we won't go down that too much more, but that's all right. Product cost is supplies needed to create a product. So direct costs of a product will invariably be product costs. Product costs are direct materials, direct labour and allocated factory overhead. This is for manufacturing business. Of course, there's a lot of service businesses as well that allocate costs to services. Also, there are plenty of retail businesses that don't produce things and they allocate their costs to the products and they don't make them. So they just got the cost of purchase. Period costs, selling expenses, advertising expenses, travel and entertainment expenses, commissions, depreciation expense, general and administrative expenses, executive and administrative salaries and benefits, office rent. These are typically ones that can be period costs, but the point is this, and they might well be for your firm, but they can also, any costs can be allocated to products if you want to, and if you can, if it's sort of feasible. Freight, again, that may or may not be allocated to products. It might be, if it was treated as a period expense, it would just be expensed each period. The thing about freight is that it's usually related, it could be freight inwards or freight outwards, but say it's the freight distributing it to a customer, that's done after the product's sold. So if that's the case, you probably won't be attaching it to the product. But again, you might, if you're interested in understanding the cost, the total cost of that product to the end customer, you might. Depreciation is a period cost for my firm. That's right. That would almost invariably be correct for most firms. Okay. All right. So product costs, they're all the costs that we attach to a product. And the key thing is they're only recognised as an expense in the income statement when the product is sold. Period costs, on the other hand, relate to the current period in question. They will be the costs that are incurred, that are expenses in the period. Key distinction in accounting. If you understand this distinction, you're well on the way to starting to understand how the accounts work. Now, this distinction between product costs and period costs is important, for example, the valuation of inventory and the determination of profit each period. If we decide to put a cost into period costs rather than product costs, then our value of inventory will be less. It will be less. We'll have less of the costs as assets in inventory and vice versa. If we put more of our costs, say, into inventory and less into period costs for the period, and inventory grows and it's sold next year, then our profit could be higher this year, depending on how we do that. And it's a judgment as to where we put the costs in the product or period. And so different people can make different judgments, and that will affect the value of inventory and the profit for the period. Key distinction in accounting. And the reason it's key distinction is because the more costs we put into period costs, the lower our profit for that year, and the higher the value of inventory and vice versa. So this is Thao's Bach. She saw all the costs of period or product costs. We either expense them in the period or we attach them to products. Now let's have a look at product costs. We're going to focus on product costs as one cost center. We saw that there could be numbers of different cost objects, but we're going to look at products. And then within product costs, Thao Bach saw them breaking up into direct and indirect costs. So what's the difference between direct costs and indirect costs? Quite a few people commented on this in this step 2. What is the difference? I've got one response. Give you a minute. Most people of the step 2s that I've marked so far, most people are pretty clear on this distinction and have commented on it. So let's. In fact, one person, I'll be putting up on Facebook probably tomorrow, one person came up with a new chart to show the difference between direct and indirect costs to replace, I think it's figure 6.1. So I thought that would be good for the study guide. I might replace the one I've got there with that, which sort of showed the distinction quite nicely in a diagram. All right, who's going to give me a response? We've got one. Any more going to tell me the difference between direct and indirect costs? What is the difference? Well, our one response says direct costs are costs we can directly attribute the reason. Well, I think we can tell the reason for all our costs, direct and indirect, why we've incurred them. But I think I understand the thinking. What you're trying to say, I think, is that direct costs we can clearly link, or anybody can link. Like Homer Simpson could link. He could see the distinction. He could see the connection between this cost and the product, the cost of the product. Whereas indirect costs, the linkages is not so clear, and it requires judgments. But again, you can use salary, wages, and electricity as examples of each of the two, but you've got to remember that those items salary, wages could easily be indirect costs too, and in fact they are. And there's indirect wages too, and electricity could be directly connected to a product. Say we had a factory that only made one product, then all the electricity of that factory would be a direct cost of the product. We could directly connect it to that product. Indirect costs are costs which are attributable to several different cost objects. Direct costs are attributable to only one cost object. That's usually true. But of course, somebody might work on multiple, that's not such a bad thing. Direct costs are allocated easily to products, but we need to make assumptions about how to attach indirect costs. That's right. It's almost a different way of saying what the previous person said. We need to make judgments when we're connecting indirect costs. Direct costs are like putting a magnet on a fridge. It just goes bing, everybody, it sort of clearly connects. There's no problem. But indirect costs, not so. We've got to sort of use a bit of blue tack or to do some judgments and think about it. Direct costs are costs that are easily linked to products such as raw materials, and indirect costs such as rent, electricity are costs that require judgment assumptions to allocate them to products. P.S. I hate Homer Simpson. Direct costs. You hate Homer Simpson, but Homer Simpson would be able to allocate direct costs to products. Anybody could. It's obvious. Direct costs are costs which are directly accountable to a cost object, whereas indirect costs are costs that are not directly accountable to a cost object. Indirect costs may be either fixed or variable. Well, direct or indirect costs can be fixed or variable. That is, it's not just indirect costs. Direct costs are quite often variable and we'll look at those issues later, but they're a completely separate concept. Direct and indirect are completely separate. And so the idea that indirect may be either fixed or variable does help reinforce this fact that they're quite distinct concepts. Direct costs are affected by the cost object directly, like fuel and maintenance for my work vehicle. However, an indirect cost is vaguer and not entirely based on the cost object, like electricity to run lights and power tools in the storage shed for that vehicle. Yes, I think you're getting to it. It's the linkage between the costs and the cost object. Direct costs, the linkage is very clear and it's objective really. Anybody would see the same one. But indirect costs, the linkages are not so clear. So judgments start to come in. Once you have judgments, different people can make different judgments. So different people could allocate indirect costs differently with products, depending on the assumptions and judgments that they've made. So different people could come up with different product costs for products, depending on how they allocate the indirect costs. That's good. Direct costs are costs that go directly to cost of products. Indirect costs are sent to the actual operating of the business. Well, you've got to be careful about the distinction between indirect costs and period costs. Period costs are not allocated to products, but indirect costs are. It's tricky, there are judgments, and there could be errors or there could be manipulation involved in allocating indirect costs to products, but they are allocated to products. Period costs are not. Direct costs to the product, for example, materials and commission. Indirect costs of product, for example, rent, office expenses. Yeah, try to get away from just giving examples. Get close to the concept. Then you'll be able to tell whether costs are or not, because the examples can vary depending on the situation. Indirect costs don't directly affect the production of products, but benefit its production. Direct costs are the costs of resources, workers, and machinery used to produce goods or services. It's true to an extent, but indirect costs do directly affect the production of products, often quite clearly in many ways. It's just that how you allocate them to the different products is not so clear. So you might be making chocolate, and one of those stages, conching or whatever it is, you're making a whole lot of, it's those costs all around that production of conching or whatever you're doing, mixing it up with different things, whatever it is clearly related to the products. It's just that you don't know which ones, because that bit of chocolate's going to be used in multiple different products. And so I'll be looking at process costing, about how you allocate the indirect cost of products. Anyway, that's good. Lots of interesting comments there. And what's the difference between direct costs and indirect costs? The link to cost objects is clear and obvious to direct costs. So forget about sort of thinking about examples of it. It's just clear and obvious, whatever the cost is. It could be electricity. If it's linked to the product is clear and obvious, it's a direct cost. And indirect costs, the link to the cost objects is less obvious and requires judgment. So Thao Bach she saw the cost of the firm could be broken into period and product costs. Product costs can be broken into direct and indirect costs. Then she thought, well, let's look at job costing and process costing approaches. These are both related to direct and indirect costs. What is the difference between job costing and process costing? And give an example of job costing and process costing from your firm. quite a lot of people didn't discuss this in their step 2, which is fine. You don't have to cover all the concepts. But what is the difference between job costing and process costing? In Thao Bach's chart, this is to do with allocating direct and indirect costs to products. So job costing and process costing in the reading were 2 different ways of doing it. What's the difference? I've got one submission in, give you a few seconds. Keep them coming in. First person said job costing refers to allocating costs based on each step in creating the individual output. Process costing, on the other hand, is utilised when the particular product isn't distinguished until the final step. Let's get in there. Job costing, that's where we can clearly see the product during, we're thinking of a manufacturing process here, it can be with services as well, but we can clearly see the product through the production process so we can allocate cost to products. It's like building an ocean liner. I don't think there'll be many ocean liners built for quite a while, but if we're building an ocean liner, you can see the product, the ocean liner. So you can attach costs to that job of building that ocean liner. And so that's job costing. Process costing is where the product doesn't emerge until towards the end of the production process. We can't see it, you know. See, we can see the ocean liner all the way through. You looked at the example of making chocolate. It could be a whole lot of other things, oil production, oil refineries and there's a whole lot of process costing. That's where we can't see the product till towards the end. So there we allocate, process is limited where there isn't distinction. So that's got those elements there. There's more to it. Is job costing like the cost of workers or relating to the jobs of the output of a product? And process cost is the cost of processing the output of a product. No, that's not it. The job costing is where we can see the product. And so the product's like a job and we just allocate it to the job, that product or service. We can see it. But where we're doing stuff and we're making multiple products and it's all mixed up, we can't see the product till towards the end. That's the process costing. Process costing is the direct and indirect costs that cannot be allocated to the product until the manufacturing process is complete. Well, we do allocate the process. We do allocate the cost to products through the manufacturing process, which could be a service or a product. So we don't just wait till the end. We can do it as we go. We do it by allocating to the process, cost of the process, and then the costs as the product goes through, as that process is used up, as the product's going through those processes, we allocate them to the products. Job costing is the direct and indirect costs that can only be allocated to one product or client, e.g. the work in process attached to the various clients in the accounting firm. That's right. That's very good. So if you are doing timesheets and so forth, and you're allocating costs to particular clients, that the client or that client job, whatever service you're providing to them, that's job costing. It's quite common in a lot of areas. Can you give an example? One person's already had, they're given the example of a working process with a client in their accounting firm. Can you give any examples from your firm or from anywhere else? Any examples of job costing and process costing for your firm? I think I gave some for Ryman Healthcare in the reading, I think. Any examples? Looked at an ocean liner. Jobs can be big, they can be small, they can be a job you're doing for a client in an accounting firm. There can be a whole ocean liner that costs a huge amount of money, or an aeroplane that they're building, costing hundreds of millions of dollars if it was an Airbus 380, which they don't make anymore. Any submissions, any ideas, and process costing. So as you get more used to your firm and understanding its processes, you'll be able to assess where the job costing and process costing is likely to be. And you'll get a sense of it. Some firms will have a lot of one or the other. Job costing, creating a slab of concrete. Process costing, restating financial statements. Like if you're building a house, like there's houses being built. I come in, there's a lot of housing building going on around Yeppoon and Rockhampton. I see houses being built all the time that are coming in. That's a job. All the costs will be allocated to that job, direct and indirect, as you're going along. Restating financial statements, I don't know. If you were doing that, and it would only take a few minutes if you were doing it as an analyst, because you're used to doing it, it would only take a short while. So you probably wouldn't allocate any costs to it because it doesn't take too long. But if it took hours and hours, like it would be taking, and that's because you don't know what the different items are, and that's the idea. You're getting just used to looking at each item, getting a bit of a feel for it. Then that might be a job, and you might allocate costs to that. Job costing, you allocate costs to products by allocating them to a specific product or group of products. So it can be a group. You know, there's the same sort of products. You might be, you might be making, Ryman Healthcare might be making a few townhouses at once. It might be half a dozen, and that could be a job. And so that's a group of products, a group of townhouses rather than just one. Process costing, allocate cost to products by allocating them to a manufacturing process. Again, that can be also in the service area. So the costs don't get allocated, they get allocated the products by first allocating them to a process, which then the products go through. Two approaches to allocating direct and indirect cost to products. So that's the important point. Job costing and process costing relate to allocating both direct and indirect costs. And that's how, you see how Thao's got that in there? She's got arrows to both. Direct and indirect costs, job costing and process costing approach. So she said all the costs are direct and indirect. Then she had a look at activity-based systems, functional-based systems, and these only relate to indirect costs. So we're talking about two different systems for allocating indirect costs. That's the focus that Thao's got there. Functional-based costing systems, that's where we make an assumption about the functional relationship between the costs and the product, and as to how they're incurred in their production and service departments. So, for example, total overheads of a production department divided by the level activity. Common activity measures, the level activity, machine hours, direct material costs, direct labour hours, direct labour costs. And so we're making an assumption. The assumption won't be strictly correct. It'll be, you know, it's an assumption. It's just so that we're allocating costs in some sort of reasonable way, those indirect costs, to the products. The activity-based costing system, and we only dealt with it very briefly in the reading, identifies the activities, what is actually being done in a firm that drives or uses up overhead or indirect costs. So that might be the time of a staff member in providing some advice to a client in an accounting firm. It's that activity of doing something. You might be reviewing their accounts first, and you might call that an activity. You can break them up into little bits or bigger bits, and you allocate your time or other resources to that activity. It measures the cost of these activities and then attaches them to each product to the extent the product uses that activity. So you might be providing some part of the advice to a client and then to the next client, the next client. So that activity of providing that advice, and gone, you've got your mic open, we'll close it, measures the cost of these activities and attaches them to the products as they use that activity. Yeah, if you could turn your mic off and gone. So we've had a little bit of a look at some of the costs using Thao Bach's chart. We've looked at product costs, period costs, and then direct and indirect costs, and some of the methods we have for allocating direct and indirect costs, and also some for allocating just indirect costs. What was the most important thing you learned today, and what questions still remain unanswered? I'll give you a minute. You've got a minute. Oh, Maria, are you there? Do you want to look at these in a minute's time?
Yep, sure, Martin. Can you hear me?
I can. You're a little bit faint. Can
Okay.
you hear me all right? I've got to talk into the mic.
Yes, I can. I've logged into the computer now, so I can actually read them better.
You're a little bit faint with me, but yeah, you are a little bit faint. So if you just...
All right. I'll try and speak close to my computer and see how we go.
Yeah. If not, I can talk as well. So
okay.
If people have trouble. We've only got one response so far. What was the most important thing you learned today? And then what questions still remain unanswered? This is one of the little tricks you can do for your learning at uni, or even going to meetings at work and other things, is you just ask yourself at the end, just spend a minute reflecting. What was the most important thing? Just one thing that I learned today, and what questions still remain unanswered? This has been well researched, this particular technique, and this can double and can incredibly increase the amount, more than double the amount of that you retain and learn from a whole hour lecture just by spending a minute at the end. Otherwise, everything can just sort of disappear, but this can help cement it in your mind. We've got 6 in now. What was the most important thing you learned today? Keep them coming in. We've got 7. 20 more seconds. Okay, Maria, do you want to kick us off?
All right. I think the first comment there is actually from one of my Mackay students, because we discussed this last week in the tutorial. The most important thing they learned was, I had wondered why the KCQs for this week's chapter was due on the Monday before the week started. I now realise that this is to force you to read and understand the chapter before you come to the lecture. That's exactly right. We strategically place your assessment due dates at certain points. So we do like you to read before you come to the lectures.
Oh, you're just on that point. A small number of students read before class. They do that. I did that as a student. I noticed my daughter does that. She's doing a master's in public health this year. She does all this. She reads the material and reads it every week. And but a surprising large number of students don't. So the idea here is you're getting the chance to experience what it's like to read before class, so you don't just come cold, and then you can start to understand the concepts rather than just superficially memorize some definition. Back to you, Maria.
Yeah, that's right. I used to read before class just so that, you know, my lecturer would think I was pretty smart because I knew all the answers. Okay, so another student has said they've learned that there is a more comprehensive description of the period and product costs. That's good, but you could have also expanded that a little bit further. Just tell us, what is that comprehensive description? So again, the key concept behind the period and product costs being one affects the balance sheet, one affects the income statement. The difference between job costing and process costing. So again, a little bit more of a flesh out, just shows us or helps others to understand what the difference is, or what the different process, so the difference between our job costs versus our process costs are. I now better understand what forms key cost relationships after seeing Thao Bach's view of costs in a firm. Yes, we love that. We love Thao Bach's.
Thao Bach has had Thao Bach has had an influence on a lot of students. we'll be developing the chart later on. We'll do this for a little while, a few more weeks. But yeah, that's Thao. And there are other people who are trying to understand the material for themselves. And that's why Thao did that chart, to try and make sense, because otherwise it can seem quite confusing, all these different concepts. Back to you, Maria.
Yeah, and I think next week Martin develops Thao Bach's little chart a little bit more. We talk about variable and fixed costs. What's the difference?
I do it quite differently to Thao, so I might share the way I view these concepts, how they relate to each other as well. Different ways of thinking about it. Back to you, Maria.
What's the difference between direct and indirect costs? And also finding each of the different things in our spreadsheet, or thinking of examples of each of these things that relates to our company, and Thao's theory and Thao Bach's ideas. Very good. Thao's system, very extremely helpful to understand the whole process, including how it broke it down into subheadings like indirect costs, direct costs, etc. That diagram will be very helpful to understand the info deeply. Well, hopefully it might spark you to think of relationships, key cost relationships in your own diagram, and you might be able to develop your own from that.
Yeah, that's an important point that person's raised there. You see how that putting things into a structure can help you understand it. Numbers of people have been doing that with some diagrams. We see that in the steps in the KCQ. Some people come up with diagrams, otherwise trying to put it together and try and see the linkages or how it's sort of structured. And Thao did it as a first-year accounting student. So this is the way, she's an example. There are other people who have been thinking about how to make sense of this from, coming at it pretty cold. And so whereas you can see the difference in thinking between, I just want to get the few facts, memorize some definitions and just move on, and perhaps give them back in an assessment. Well, have you really understood very much about these concepts? Whereas somebody like Thao Bach is trying to make sense of it. She's gone on and been an accountant for quite a long time, and people really like having people, graduates and people coming in who understand some of these things and have got some sort of depth to it, and then they can build on that with their practical experience. Back to you, Maria.
Past students' mind map of costs and approaches from chapter 6. Very useful to see all the concepts I am learning about laid out. So that's good.
Great. Good old Thao Bach. She's a bit of a star, isn't she? Now, what about what questions still remain unanswered? What questions still remain unanswered? We will answer your questions. Maria, do you want to kick off?
There's only two. I've only got two on my screen. One says none.
Yeah, we've only got one, haven't we? Should we wait? We might wait a few seconds. I want to get going. Other people can write their questions as we go.
All right, sounds good. So why do period costs, product costs, direct costs and indirect costs have to be so confusing and similar? Why isn't Thao's diagram in the study guide? I'll give you my view on that. Well, costs are complex. I mean, if they were all easy, we wouldn't really need accountants, would we? You wouldn't need to be in class. So the nature of costs are complex because there are so many different perspectives and different ways that we can classify them, some more useful than others. And why isn't Thao's diagram in the study guide? Well, you'll see next week, Martin makes a few modifications to Thao's diagram. So it's a wait to be seen for next week. Martin, do you want to comment on that one?
I could put Thao's in the study guide. A lot of people come up with different charts, actually. Quite a lot of the study guide material and the illustrations are from past students. Different people have come up with different ideas, including someone with a chart which I read yesterday on figure 6.1. You know, the Kinder Surprise illustration, I can remember that student that different people came up with different ideas over the years as ways of trying to make sense of these concepts. And so we just sort of bring it back to you so that you can sort of see how others are trying to make sense of it. And that's very good, because I learned these concepts a long time ago. And so I understand a lot about these concepts too, much deeply, and you know, so it can be hard sometimes for me to explain it in a way that can really connect. Our students who are thinking it through have some great illustrations. But and also we have to leave something for the lecture, don't we, if we have everything study guide. But we'll talk about that next week, and you might like to raise that question again or have further thoughts on it. Back to you, Maria.
Very good. What my own company's product costs, period costs, job costings, and period costings are. So that's a really good question. And that's something that we want you to start discussing in your tutorials. Of course, you'll be covering assignment 2 in your tutorials as well, but these are important key concepts to discuss. So each of your companies will have some information on its inventory, so you can have a look in there. Start with that note in your financial statements. Have a look and see if you can identify, for example, some of the product costs. Have a look at what costs that are left in your inventories on your balance sheet. Have a look to see if your company discloses cost of goods sold. Now, not all companies will. Some will disclose it in the income statement. Some may disclose it in the notes. You know, so again, your understanding of the period cost, so cost of goods sold becoming part of, you know, converting that product cost from the balance sheet over to the period cost in the income statement. Have a look and see what method they use, whether they use a project costing or a job costing approach. Have a look at the type of products that they actually sell or services that they provide. So this is a really good question that remains unanswered, because you can flesh that out as much as you'd like to using your own company, and also using the companies of your peers, comparing between your firms. And hopefully, by fleshing that out a bit more, you'll help consolidate your understanding of these key concepts. And remember, all of these different things, you know, the period costs, the product costs, direct costs, indirect costs. Next week, we look at fixed costs and variable costs. So there's so many different perspectives and classifications of costs, and systems for classifying costs that can result in different profits for periods, in different profits between firms. And that's something that we take further next week. And also, if you continue on in an accounting degree, when you study management accounting, we actually spend weeks dedicated to each one of these different classifications. So lots to look forward to. And if you can flesh that question out now with your companies, that will only help your understanding of all of the different cost concepts that we've looked at. Did you want to say something on that too, Martin?
Yeah, this is where you can start to look at the footnotes. If you're curious about how your firm how is it managing these sorts of costs, product costs, period costs, job costs, all these different things. There's the first footnote in your accounts is not a footnote. It just gives you the accounting policies. So you can have a bit of a look in there. Also, you can look under inventory and see how they're valuing their inventory and doing stuff. And this is something that we do for those who are studying accounting, bachelor accounting. In the next unit, Introductory Financial Accounting, you'll have the opportunity to do a bit of that. And so you'll be building on some of these concepts as you look at your own firms and how they're handling some of these. Because quite a few people have got the idea now that they started thinking that accounting was clear-cut, black and white. The numbers were the answer. The numbers were it. Now, quite a few people are starting to get the idea that there are a lot of judgments in accounting, and that you need to understand how these are put together to be able to interpret them. And a number of people have been thinking through the question that is one of the questions in our unit. Why is is, can accounting help or perhaps hinder us to better understand what is really going on in our firm? Can it do that, and how can it? And people are coming up with a few thoughts around that. And it's been very interesting to see how people are making some depth of understanding around those sorts of questions. And we'll be sort of closing the loop on some of this stuff towards the end of the term. So I don't want to be spoilers, but people are thinking through these issues. So you can have a look at the footnotes if you're curious about your firm, particularly the accounting policies could be helpful in certain areas. Also, you can look at some of the footnotes around inventory or perhaps some other items. And you can get a bit of a sense of where they're going in that. Having said that, with published accounts of firms, particularly around expenses, there's not much disclosure. So there's not a lot. Firms are not required to, and they tend not to want to. So it's sort of going to be a bit varied, some of these treatments. That's me. Are there any other, no more answers to that one? Okay. Now, I think Natasha has her mic open. Now, we're going to summarise now. What have we looked at? We've looked at cost objects. Cost objects, they're not cost objectives. Call them cost objects. And cost objects are any aspect of the firm that we want to know the costs. And if we want to know the costs of something, and it can be a product, which is what we're focusing on, but it can be a business process, it can be a customer, it can be anything. We might like to know the cost of our customer service in various areas, answering the phone or doing various things. Oh, Natasha, if you could turn your mic off. And so cost object can be any aspect that we want to know the cost of the firm.
Martin, my mic was off.
Oh, if you could turn it off again, that'd be great. Thank you all. Don't know what's happening. There might be two Natashas.
Oh, okay, that explains it.
Yeah, there's another Natasha. And that's the cost objects. This is a key concept. This is something new for most people. They didn't realise that we attach our costs to objects, and that they can be anything in the firm. But we're focusing on products as we look at some of the complexity. It's only introductory, but you get a little bit of a sense of the complexity of this. If your business is of a reasonable size and diversity, it becomes quite complex. If it's pretty simple, then it's not so difficult. But some people have seen, for example, they might have a stall at a market, and they're starting to see how these concepts firm. Kishav, Tian Shirao, you need to turn the mics off. They've seen how they can apply those concepts to what they were doing. And they can see that they're actually using some of these concepts as well. Period and product cost, this is the key distinction. If you take nothing, cost objects, the fact is a key concept because that's, we attach the cost of cost objects, that's very important. But period, the distinction between period and product costs is critical in accounting. If you can have a good grip on that distinction, you're on the road to understanding accounting. And there are judgments between period and product costs. And we saw that period costs are costs that we expense in the period. And so they will go as expenses in the period, and revenue less expenses equals profit. So they'll reduce our profit. To the extent we put product costs, they're not expensed in the period. They're not expenses. They're an asset. So the product costs are an asset. They're part of inventory. And so they sit in our inventory until the inventory is sold. And it's only when the inventory is sold that we recognise these product costs as expenses, and the expense is called cost of goods sold. We'll be looking at all these things in the future. Direct and indirect costs was the other key concepts. The distinction between direct and indirect. Direct costs are clearly linked to, we're looking at products. It could be any cost object, but we'll talk products. Direct costs are clearly linked to a product. There's no judgments. It's obvious. Homer Simpson, whether you like him or not, he would know that was a cost, that direct cost was a direct cost of a product. He would be able to attach the cost to a product. It's obvious. Indirect costs are not obvious. They require judgment, and they and so different people can make different judgments, and that's fine. It's all legal. It's not like and they could do it dishonestly, or they could just make a mistake in various ways, because there's judgments involved and some assumptions. We looked at job costing and process costing. They're methods of allocating both direct and indirect costs to products. So job costing is when we can identify the product or service all the way through. So we might as well just attach the costs to that job. The job could be an individual product or a group of products, and it's used widely, and you're probably using it in various service industries that you might be working in. And the process costing is where we're attaching both direct and indirect costs to products, but we're doing it where we can't identify the product. And so we do it to processes. And then from the process, we attach them to the products going through. Then we saw functional-based costing systems and activity-based costing systems. These both relate to indirect costs. So whether we use job costing or process costing, we could say use a functional-based costing. Down here, you've got your mic open, and Tasha, if you could close your mics. And we've got functional, you could use a functional-based costing system with, you could be using job costing or process costing. And functional-based costing systems, which are quite common, is where we make assumptions about the relationship of the indirect costs to the product. And we saw some common examples of that in manufacturing, but the same applies to service. And we'll be looking at these things a bit more in future. Activity-based costing systems are where we come up with the cost of an activity. And then as products use that activity, then we'll it's a bit like you might have an activity called restating financial statements, as someone suggested in their minute paper. And that might be an activity that's used by a number of different clients or a number of different jobs. You might have a job costing approach. And so you might say it costs you, $100 to restate a financial statement with this. That's the cost of the activity when you put all the costs together. And then as you restate a financial statement for each client or whatever you do, you can then allocate that $100, the cost of the activity. We only look at these very simply at this stage. Lots of issues with all of these, but that's just a little introduction. We did the minute paper, and you can see that people are starting to understand some of these concepts and some of these distinctions. All right, well, that leaves us, that's the end of our class today. We'll have a break now, and then we'll go into our workshops. Thank you very much. Bye for now. Bye.